From a guy who tanked his entire trade on one bad call, to another who let FOMO push him straight into a loss. These are the classic beginner trader mistakes you'll want to dodge, starting with overtrading. Overtrading is the kind of move new traders make out of nowhere, just based on the movement of the candles. For example, when a candle goes down after hitting resistance, they set the target bar low to make some quick money, but it ultimately doesn't help, because the breakout point doesn't tell the whole story, and the candles can shoot back up within seconds. That's where major losses happen. Take this guy's trade, for example. He only made the mistake of setting his target too low, which ultimately backfired. This shows that trading is all about skills, not about gambling, and he's a noob. SMC, Smart Money Concepts. Smart Money Concepts is all about following big institutional traders, assuming their moves will lead to profits. But it's tricky. By the time you spot their move, it's often too late. The market can be manipulated, and trying to track smart money can quickly turn into a trap. Example, take this trader for instance. He tried to predict the market based on past activity, but that's where things went wrong. After a big drop, he assumed the market would bounce back and made the mistake of following the trend too soon. It backfired badly. Lesson learned. Smart money isn't always so smart. Unless you're a big-time institution, maybe skip the SMC and save yourself from getting slammed like a wrestler in a pile driver. Bad analysis. Bad analysis is when you trade based on weak research, random hunches, or whatever some guy on the internet said while sipping an energy drink. It's all noise, no signal. This thing never works because the market isn't guessing, it's calculating. And if your data's off, your decisions are dead on arrival. Take this guy, for example. He tried to predict market flow using short-term analysis, thinking it would go higher. But without a solid foundation, his trade fell apart before it even had a chance. And this is where things took a turn. So yeah, trade smart, or prepare to explain to your cat why rent's late. Again, hasty trades. Hasty trades are what happen when your finger moves faster than your brain, but it doesn't work because trading isn't speed dating. Rushing in means missing the red flags, the fake outs, and the fact that you just bought the top again. For example, this guy did a quick recap and tried to trade based on the previous movement, which didn't end well. But after failing this time as the market moves into an uptrend, he expected it to go higher like previous trends, which once again proved him wrong. The lesson: slow is smooth. Smooth is profit. Or keep panic buying dips that weren't dips and enjoy your new job as a full-time chart victim. FOMO trading. Fear of missing out. AKA FOMO trading is when you see a price pumping and your brain screams, buy now or cry forever. So you dive in, late, loud, and totally unprepared. For example, after seeing the huge uptrend, this guy thought he was going to miss out on big profits and jumped into the trades. And this is where things went wrong. So trade with logic, not panic. Or keep chasing rockets that already left the launch pad, without you on them. Bad prediction. Bad prediction is when a trader thinks they've cracked the code, until reality smacks them with a stop loss. But instead of accepting it, they double down, thinking it has to go up now. But it's a mistake because the market doesn't care about your feelings. It's not waiting for your comeback, it's busy breaking your confidence. Take this guy, for example, who started selling his trades as the market was going down, which didn't end well. However, he made a bad prediction once again, thinking the trend wouldn't go up after hitting the stop loss. Lesson learned: predict less, react more. Or keep treating the charts like a wish list and get served another helping of humble pie. Impatience in trading. Impatience in trading is when you stare at the chart for 5 minutes and decide it's been long enough. No signal, no problem, you just click buy out of boredom. But if you're trading out of restlessness, you're not a trader, you're a gambler in a hurry. Just like this guy right here who threw all his money into a trade out of impatience, only for the market to slam the brakes and go the other way. This is why you should chill. The market isn't going anywhere, but your money sure will if you keep treating every candle like a countdown. Falling for the trap. Not spotting the trap is classic rookie pain. You see a red streak, panic kicks in, and you smash sell like it's a fire drill. But when you zoom out, the market was just breathing before the real move up. Short-term fear blinds you to long-term logic. The pros are waiting for confirmation. You just sold low, right before it went high. Just like this tutorial, which showed where most people fail and how to avoid this. So, patience isn't boring, it's profit. Or keep jumping at every red candle like it's a haunted house. Losing your psychology. The moment a trade goes red, the new trader's brain melts. Confidence? Gone. Strategy? Forgotten. Now it's just panic, revenge trades, and staring at charts like they personally betrayed you. But the real picture is different. Emotional trading turns a small loss into a full-blown meltdown, and you're no longer trading the market, you're wrestling your own ego. Take this guy who actually set his target to low, assuming the market will go down. But as soon as things slowed down, he lost patience and jumped into the uptrend. Desperation trading that didn't help him one bit. Losses are part of the game, but if you lose your cool, you lose your capital. Keep your head because your emotions aren't a trading strategy. Ignoring selling pressure. Some new traders fall in love with patterns, head and shoulders, triangles, fairy wings. But while they're busy sketching shapes, they're blind to the one thing that actually matters. Selling pressure. The market isn't here to respect your pretty lines. If big players are dumping, your pattern's just a trap with decorations. Just like this guy who lost money by ignoring selling pressure and obsessing over patterns instead. The lesson: patterns don't print profits, price action does. Using random indicators. Random indicators are a rookie's favorite toy. RSI, MACD, Fibonacci, and many more are there. But without real understanding, it's just chart clutter because mixed signals lead to mixed results. One says buy, the other screams run, and you're left confused and broke. Just like this next guy who jumped into using indicators without even testing them first. And lessons learned. Trading against the trend. Going against the trend is like swimming upstream during a flood. You're not brave, you're just begging to drown. Why is it bad? Because trends exist for a reason. Fighting momentum with hope isn't strategy, it's self-sabotage. And this video right here perfectly shows how newbie traders fall into the same trap again and again.
Example, right? And traders that are beginners, they're looking for reversal trades and they see this horizontal level right here. Okay, so they're saying, okay, this is a key resistance level. I'm gonna take the trade. And so they take the trade, and what happens? Boom, stopped out, right? And we talked about that a little bit in last week's video about getting stuck with this, right? So the first thing is you can easily get stopped out on horizontal trend lines. But if you're trading in the direction of the overall trend.
So the bottom line, the trend is your friend until you ignore it. Then it's your worst enemy in a green candle disguise. Taking too much risk without prior knowledge. Jumping into risky trades without knowing what you're doing is like diving into shark-infested waters with floaties. It's reckless, dangerous, and a fast track to disaster. Trading isn't a game of chance, it's a calculated battle. While some thrill seekers love to bet big on a whim, in real trading that's an instant recipe for wiping out your account. Just like how he explains it here.
Say, okay, the breakout, look at this big huge bar. See this big bull candle? It's like, man, this thing's going, I need to get in on it. It's the fear of missing out is screaming, and you're like, this is gonna go, we're having all the way up here, right? I get it. You need to trade small, because what happens is, if you trade big, you get reversed, and the next thing you know, you're like, oh, I don't wanna take that loss, it's too much money. It's too much money, I don't wanna take this here. So what do? You move your stop. Big no-no, big no-no. And then the next thing you know, you're trading even more, and then we see the reversal candle and it's going, and you're like in a lot of pain, and so rather than dealing with it, you just let the account take you out. You end up blowing your whole account. Now you go through all this emotional pain, emotional baggage.
So if you're risking it all without a clue, you might as well hand your money over and wave goodbye to your bankroll. The M pattern doesn't work in a downtrend. The M pattern is supposed to signal a top, but trying to trade it in a downtrend is like using a map upside down. You're lost before you even start. Even though it looks neat on charts, but in a strong downtrend, it's just a fancy way to get caught on the wrong side. Just like this guy who tried to trade the M pattern during a downtrend and paid the price for it. If you trust it blindly here, you might as well be throwing darts blindfolded and hoping for a bullseye. Plus, no one wants to be the trader stuck riding a sinking ship because of a misleading pattern. Trusting RSI divergence. RSI divergence happens when the price moves one way, but the RSI indicator says something different. It's like your speedometer showing fast while you're barely moving. Traders like it because it can mean a change is coming. But it's not always right. If you jump in too soon thinking the trend will change, you might get stuck in a losing trade. For example, this trade shows how things went wrong just because of the RSI divergence.
Break. Listen, when a price is trending down, right? And you're creating lower lows constantly lower lows, constantly lower lows, and on the RSI, you're making higher lows. This is a trending market, and you're trying to fight a trending market. You need to wait for the trend line of the trending market to break before you get into a divergence trade. What that looks like is this. We have a trend line. We have lower lows. We have higher lows on the RSI. The trend line broke, retested, and went up. Wait for the price to break this damn yellow.
Ignoring the bigger picture is like guessing the weather by just looking at one cloud. And nobody wants to be the trader who bought high or sold low because they trusted a false signal. Trading without a stop loss. Trading without a stop loss is like driving without brakes. Sure, it feels risky, but it's a quick way to crash. A stop loss helps protect you if the trade goes wrong. Without it, one bad move can wipe out your whole account. The next clip shows how fast things can go south when you skip setting a stop loss.
Right here. Market was in an uptrend. You see these big engulfing candles down and you're like, hell yeah, this thing broke the trend line. I'm going to target this low point right here because, why not? And I'm not going to put a stop loss in. So that's what my trade looks like. Enter trade, and I'm going to go grab a coffee, and then I'm going to watch this thing play out. And you come back a few minutes later, and your account is either completely at zero and blown, or you're in such a deficit that it hurts your guts. Your insides are like rotting, and you're crying, and you're emotional because you didn't trade with a stop loss.
So, if you skip setting stops, you might as well be throwing your money into a bonfire and watching it burn. Avoiding false breakout. False breakouts are like fake doors in a maze. They look real, then slam you with losses. That's where the chandelier exit comes in. It helps you spot the real moves by tracking price with volatility, not just lines on a chart. Instead of jumping at every breakout, the chandelier keeps you patient. It waits for price to break and stay above a certain level before giving the green light.
For example, we find some key points that are great levels to make a support and resistance. Once we set our trend lines, we wait for a momentum candle to break through our resistance. One candle breaks the line, but it does not have a big enough body to be considered a momentum candle. So we wait for 2 more green candles. Once we see the 3rd green candle, we enter the trade. We then put our stop loss below the resistance line and set our take profit to a 1.5 ratio. We then wait for the price to hit our take profit, then we sell half of our shares. After we sold half of our shares, we move our stop loss to our old take profit mark. Then we turn on the chandelier indicator. We then wait to sell the other half of our shares until the chandelier indicator turns colors. Once it does,
Use it right and you'll avoid chasing fake pumps and getting trapped, because no one wants to be the trader who bought the breakout right before the breakdown. Relying heavily on past performance. Relying too much on past performance is like assuming your high school glory days will win you a medal today. Just because a setup worked before doesn't mean it's still the golden ticket. Just like this video shows, past performance isn't always enough to guarantee success in the market.
Now they pull back down. Now people say that, oh, this is maybe the cup with handle pattern. They break out, it will go up higher. But it's not the case. The market go the other way and pull back down. So when the market pull back down, people think, oh, this is a wet. When they break this way here, they go down to short. But now the market make another wet here. People thinking, okay, now if it break this level here, I'm going to short. They will go lower. But the market go the other way and go higher. So you can see that, you cannot rely too heavily on the past performance.
The markets change. Conditions shift. What worked last month might fail miserably today. Blindly copying past trades is more guesswork than strategy. Triple tap pattern. The triple top pattern looks like a strong reversal, 3 peaks hitting resistance and failing to break through. It's supposed to scream sell, but only if it forms in the right conditions. The problem? New traders spot 3 humps and jump the gun, but without volume drop or a solid neckline break, it's just a bumpy ride to nowhere. So treat the triple top like a warning, not a promise. Or end up as the trader who fought a trend with nothing but hope and 3 wobbly peaks. Directly jumping into the real account. Jumping into a real account without using a demo first is like stepping into the ring after watching a training video. You're getting knocked out before the bell rings. A demo account lets you test strategies, learn the tools, and mess up without losing real money. It's where mistakes are lessons, not losses. Some new traders skip practice thinking they're ready, and that's exactly where things go wrong. Just like this guy who tried to predict the market without training and paid the price. So yeah, train in the demo gym before you fight with real cash, because no one wants to be the trader who blew their account just to see what happens. Liquidity grab. A liquidity grab is when the market fakes a breakout just to hunt stop losses and scoop up orders. It's like a magician's trick, flashy move one way, then boom, reversal. It looks real, feels real, and traps tons of traders every time. The big players need buyers or sellers to fill their orders, so they bait the trap and retail traders bite. Remember that time you went long on a breakout and it instantly reversed? Yeah, that wasn't momentum. That was your stop feeding a whale. So don't fall for the bait. Wait for confirmation. Or keep donating to the pros one fake out at a time. And if you like this video, then you might like a similar one on the left or my newest upload on the right.